our knowledge series on corporate tax in UAE. The video covers following important matters: exempt persons, government entities, government-controlled entities, extractive businesses, non-extractive natural resource businesses, qualifying public benefit entities, qualifying investment funds, Social Security Fund or Public Pension Fund, corporate tax registration and application for exemption, ceasing to be an exempt person, family foundations. Introduction. UAE corporate tax is exempted for certain categories of persons and their activities. This exemption is by default for some categories of persons. However, exemptions must be applied by other persons. Exempt persons. Under Article 4.1 of the Corporate Tax Law, following category of persons are automatically exempt from corporate tax: government entities, government-controlled entities that are specified in a cabinet decision. Following persons are exempt from corporate tax if they send notification to the Ministry of Finance, subject to meeting the certain conditions: extractive businesses, non-extractive natural resource businesses. Following person is exempt from corporate tax if listed in a cabinet decision: qualifying public benefit entities (QPBE), which are listed in Cabinet Decision Number 37 of 2023 to be a QPBE. Following persons are exempt if applied and approved by the authority, subject to meeting certain conditions: qualifying investment funds, Social Security Fund or Public Pension Fund, or a regulated Social Security Fund or private pension fund regulated by competent authorities in the UAE. A UAE juridical person wholly owned and controlled by any of the exempt persons referred to in points A, B, F and G, that is undertaking part or all of the activities of the exempt person or is engaging exclusively in investing funds or holding assets for the benefit of the exempt person, or is carrying out activities only that are ancillary to those carried out by the exempt person. Any other persons as determined by cabinet decision. Corporate tax registration and application for exemption. According to Ministerial Decision Number 43 of 2023, the following provisions apply. Persons in categories A to D, which are exempt by default, do not need to register for UAE corporate tax unless they otherwise become a taxable person under the provisions of the Corporate Tax Law. According to the authority's Decision Number 7 of 2023, the following provisions apply. As per Article 2.1 of FTA Decision Number 7 of 2023, qualifying public benefit entities, Category E, must apply for tax registration and obtain a tax registration number as of October 1, 2023. As per Article 2.2 and 2.3 of FTA Decision Number 7 of 2023, all other persons who need to apply for exemptions, that is, those in categories F to I, must apply for tax registration and obtain a tax registration number as of June 1, 2024. If the authority approves the application for tax registration, then persons in categories F to I may be entitled to submit an application for exemption from corporate tax where the relevant exemption conditions are met. As per Article 2.4 of FTA Decision Number 7 of 2023, the authority may request that exempt persons in categories E to I for filing an annual declaration confirming that they still fulfill the exemption conditions. Ceasing to be an exempt person. Overview. As per Article 4.5 of the Corporate Tax Law, if an exempt person ceases to meet the conditions of an exempt person, then that person ceases to be an exempt person from the beginning of the tax period in which the conditions are not met. As per Article 4.6 of the Corporate Tax Law, the Minister may prescribe when a person may continue to be an exempt person or cease to be an exempt person if failure to meet the conditions is of a temporary nature and will be promptly rectified, and appropriate procedures are in place to monitor the compliance with the relevant conditions. Failure to meet the conditions is the result of the liquidation or termination of the person. Any other instance as prescribed by the Minister. Liquidation or termination deeming to be an exempt person. As per Article 2.1 of Ministerial Decision Number 105 of 2023, where the person ceases to meet the conditions to be an exempt person because of liquidation or termination, the person is deemed to be an exempt person from the date its liquidation or termination procedure starts until the date it is completed, provided that a notification has been submitted to the authority within 20 business days from the date of the beginning of the procedures. As per Article 2.2 of Ministerial Decision Number 105 of 2023, the person ceases to be deemed an exempt person the day after the liquidation or termination procedure completes. Temporary failure to meet the conditions, deeming to be an exempt person. As per the Article 3 of Ministerial Decision Number 105 of 2023, where failure to meet the conditions is temporary and will be promptly rectified as mentioned in Article 4.6b of the Corporate Tax Law, the person will be deemed to be an exempt person if the authority approves the application, and the person meets all of the following conditions. The person has made an application to the authority to continue to be treated as an exempt person within 20 business days from the date it fails to meet the conditions to be exempt. The failure to meet the conditions is due to a situation or an event beyond the person's control which could not reasonably have been predicted or prevented. It reasonably expects to be able to rectify the failure to meet the conditions within 20 business days from the submission of the application to the authority. This period may be further extended by another 20 days, if the continued failure is beyond the person's reasonable control. Upon request by the authority, the person provides evidence to support putting in place the appropriate procedures to monitor the compliance with the relevant conditions, within 20 business days from the date of the request by the authority, or any other period as may be determined by the authority. Ceasing to be an exempt person to gain a corporate tax advantage. As per Article 4 of Ministerial Decision Number 105 of 2023, if gaining a corporate tax advantage is the motive for ceasing to qualify as an exempt person, then the person will cease to qualify as an exempt person from the date it ceases to meet the conditions to qualify rather than from the beginning of the tax period in which the conditions cease to be met. Government entities. Government entities include the federal government, local governments, ministries, government departments, government agencies, authorities and public institutions of the federal government or local governments. These and other government entities are considered administrative bodies that carry out government functions under the control of the federal government or local government. Examples of government entities include the UAE ministries and federal authorities and the municipalities, departments, and agencies of each local government. Government is exempt in its own activities from taxation, as those activities are generally conducted as part of the government's duties. Government entities are therefore considered exempt persons for UAE corporate tax purposes under Article 4.1a of the Corporate Tax Law. However, on occasion a government entity may conduct activities that are beyond sovereign function and can be defined as commercial activities which could be conducted through an association with external parties. Juridical persons that are used by government entities to carry out certain activities of the federal or local governments under outsourcing and other arrangements shall not be considered government entities. As per Article 5.3 and 5.4 of the Corporate Tax Law, where a government entity undertakes a business activity under a trade license, the related income will be within the scope of UAE corporate tax. In that case, separate financial records must be kept so that the taxable income may be calculated. As per Article 5.5 of the Corporate Tax Law, where a government entity has a business activity, this business element is treated as a separate business which is a related party. This means that transactions between the business element and the non-business departments or activities of the government entity are treated for corporate tax as related party transactions, which falls within the transfer pricing provisions. Government entities, treatment as a single taxable person. As per Article 5.6 of the Corporate Tax Law, it is possible for a government entity to apply to the authority for all its activities to be treated as made by one taxable person subject to certain conditions. As per Article 5 of Ministerial Decision Number 68 of 2023, the financial results, assets, and liabilities of all businesses and business activities attributable to the government entity can be consolidated. To avoid double counting, transactions between the different parts of the single taxable person shall be excluded. Therefore, only transactions with parties external to the single taxable person are consolidated into its financial results. As per Article 4.1 of Ministerial Decision No. 68 of 2023, this treatment applies from the beginning of the tax period specified in the application submitted to the authority, or from the beginning of any other tax period determined by the authority. Grouping different business and business activities conducted by a government entity as one single taxable person is different from grouping different taxable persons as a tax group, which is under Article 40 of the Corporate Tax Law. Federal government entities, treatment as a single taxable person. Conditions to be treated as a single taxable person. As per Article 2 of Ministerial Decision No. 68 of 2023, the following conditions must be met to treat the federal government's businesses and business activities as a single taxable person. The businesses and business activities of the federal government entities must be carried out under a license issued by a licensing authority. The application to be treated as a single taxable person must include all businesses and business activities conducted by the federal government entities. The application to the authority to be treated as a single taxable person can only be made by the representative federal government entity, which is defined as the federal government entity mandated by the federal government to represent the federal government entities that are to be treated as a single taxable person. Administrative requirements. The authority must be notified of the appointment of the representative federal government entity. As per Article 2.3 of Ministerial Decision No. 68 of 2023, if the federal government entities that are treated as a single taxable person wish to replace their representative entity whilst continuing as a single taxable person, then an application must be made to the authority to replace the representative federal government entity. As per Article 2.4 of Ministerial Decision No. 68 of 2023, any new businesses or business activities conducted by the federal government entity, which meets the required conditions, must be directly treated as part of the single taxable person, and the representative federal government entity shall notify the authority within 20 business days of the new business or business activity commencing. As per Article 2.5 of Ministerial Decision No. 68 of 2023, the representative federal government entity must notify the authority within 20 business days of any business or business activity ceases to be carried out by the federal government entity. Any business or business activity ceases to be carried out under a license issued by a licensing authority. As per Article 2.6 of Ministerial Decision No. 68 of 2023, the treatment as a single taxable person will cease if either the authority approves an application made by the representative federal government entity to cease being treated as a single taxable person, or the representative federal government entity ceases to meet the conditions to be treated as a single taxable person. Government-controlled entities. As per Article 1 of the Corporate Law, a government-controlled entity is any juridical person, directly or indirectly wholly owned and controlled by a government entity, that has been specified in a cabinet decision issued at the suggestion of the minister. A government-owned UAE company may carry out a mandated activity, typically where this activity needs to be separated from the government entity itself for management or accountability. Like government entities' activities, mandated activities, with no commercial or business aspect, are exempt from corporate tax. As per Article 6.2 of the Corporate Tax Law, non-mandated activities are taxable. As per Article 1 of the Corporate Tax Law, a mandated activity is any activity conducted by a government-controlled entity in accordance with the legal instrument establishing or regulating the entity, that is specified in a decision issued by the Cabinet at the suggestion of the Minister. As per Articles 6.3 and 6.4 of the Corporate Tax Law, where a government-controlled entity undertakes other business activities, aside from the mandated activities, the resulting income is within the scope of UAE corporate tax. Separate financial records must be kept so that the taxable income may be calculated. As per Article 6.5 of the Corporate Tax Law, transactions between the business element and the mandated departments or activities of the government-controlled entity are treated for corporate tax as related party transactions, which falls within the transfer pricing provisions. Subsidiaries of government-controlled entities. As per Article 4.1h of the Corporate Tax, if a UAE subsidiary that is wholly controlled by a government company undertakes some or all the mandated activity, or activities which are ancillary to this, or is engaged exclusively in holding assets or investing funds for the benefit of the exempt person, the subsidiary may also be treated as exempt from corporate tax to the extent of those activities. Extraction of natural resources. As per Article 1 of the Corporate Tax Law, natural resources include water, oil, gas, coal, naturally formed minerals, and other non-renewable, non-living natural resources that may be extracted from the UAE territory. As per Article 4.1c and 4.1d of the Corporate Tax Law, there are exemptions for both extractive businesses and non-extractive natural resources businesses. As per Article 1 of the Corporate Tax Law, extractive business is defined as the business or business activity of exploring, extracting, removing, or otherwise producing and exploiting the natural resources of the state or any interest therein as determined by the minister. And non-extractive natural resource business is defined as the business or business activity of separating, treating, refining, processing, storing, transporting, marketing or distributing the natural resources of the state. The share of income earned directly by a government entity, or any royalties and other levies raised by a government entity from the extraction or production of natural resources by private companies will be outside the scope of corporate tax. According to the law, natural resources in the UAE belong to the emirate where those resources are extracted. The emirate may levy its own taxes at the emirate level. This tax on extraction income affects the treatment for federal corporate tax, meaning that an extractive business can only be subject to federal corporate tax if it is not already subject to emirate-level taxation, provided that the relevant conditions are met. The contract under which extraction or exploitation is carried out determines how any income relating to natural resources is taxed, at either emirate or federal level. In most cases, there will be a concession agreement between the business and the relevant emirate government, which usually include provision for emirate-level taxation. As per Article 7.1a and b of the Corporate Tax Law, a person holding a right, license or concession from a local government to undertake extraction activities which is subject to emirate-level taxation will be exempt from federal corporate tax. As per Article 7.2 and 7.3 of the Corporate Tax Law, a business may have other activities which falls outside the exemption, provided that the other activities are ancillary to the extraction activities, and they provide up to 5% of the total revenue in any tax period. Unless the revenues from other activities are within this de minimis, income from the other activities will fall within the scope of federal corporate tax except where any further exemption applies. As per Article 7.4 of the Corporate Tax Law, where an extraction business has other activities which fall outside this exception, that is, they are not ancillary to extraction and/or they provide more than 5% of the total revenue in a tax period, the taxable income of the person's other business is calculated as follows. The other business is treated as separate from the extraction activities for corporate tax purposes, with separate records required. Common expenditure pertaining to extraction and other activities must be apportioned in proportion to the relevant revenue, unless a different apportionment has been used in arriving at any emirate-level tax calculation, in which case the same apportionment is used for federal corporate tax purposes. And, to check whether the other activities fall within the de minimis, a business undertaking both extraction and other activities will need to perform calculations every year, and if required, make the appropriate apportionment of expenditure. Illustration: Expenses apportionment. Alpha LLC is a UAE company that is involved in the extraction of oil in the Emirate of Abu Dhabi. Under the Abu Dhabi Emirate-level laws, expenses are apportioned by 70% of all expenses being allocated to the extraction of oil, which is subject to Emirate-wide tax laws. In this instance, the apportionment method specified under the emirate level tax laws will take precedence over any regular apportionment methods. Non-extractive natural resource business. As per Article 1 and 4.1d of the Corporate Tax Law, non-extractive natural resources businesses are business or business activities of separating, treating, refining, processing, storing, transporting, marketing or distributing the natural resources of the UAE. As per Article 8 of the Corporate Tax Law, the exemptions for exploitation of natural resources closely resemble those applicable for the extractive business. As per Article 8.1a, 8.1c, and 8.6 of the Corporate Tax Law, a business holding a right, license or concession from a local government to undertake non-extraction activities which is subject to emirate-level taxation will be exempt from federal corporate tax. As per Article 8.1b of the Corporate Tax Law, to qualify as exempt under Article 4.1d, a non-extractive natural resource business must exclusively supply to other businesses, that is, sales must be business to business (B2B) rather than business to consumer (B2C). If income is derived from anyone who is not within the scope of the Corporate Tax Law, for example, natural persons who do not undertake a business or business activity, or any other person that is not a business or an organized entity, the exemption from corporate tax under Article 4.1d is not available. This requirement does not apply to extractive businesses. As per Article 8.3 and 8.4 of the Corporate Tax Law, a similar de minimis rule which is applicable to extractive businesses applies to non-extractive natural resource businesses for ancillary activities where they do not contribute more than 5% of revenue in a tax period. The other business is treated as separate from the non-extractive natural resource business for the purpose of corporate tax, where the 5% limit is exceeded, in which case separate financial records are required to be maintained. Common expenditure pertaining to exploitation and other activities must be apportioned between the two activities in proportion to the relevant revenue, unless a different apportionment has been used in arriving at emirate-level tax calculation, in which case the same apportionment is also used for federal corporate tax. As per Article 8.5 of the Corporate Tax Law, transactions between the exploitation element and the other business element of an exploitation company are treated as related party transactions for corporate tax purpose, unless the other business falls within the exemption for extractive businesses. As per Article 8.7 of the Corporate Tax Law, the non-extractive natural resource business exemptions do not extend to any suppliers, contractors or subcontractors used by the exempt business. As per Articles 7 and 8 of the Corporate Tax Law, where one entity is commonly engaged in both extraction and exploitation, non-extraction, of natural resources, both activities, as well as any other activities, will need to be considered for potential exemption under relevant articles of the law. Illustration: non-extractive natural resource business. Beta LLC is an oil business in the Emirate of Abu Dhabi. The contract between Beta LLC and the Emirate includes a provision for the Emirate to levy tax. 99% of Beta LLC's revenue this year was generated by its processing activities under this contract, which are applied after oil extraction and before being delivered to customers. Beta LLC's other activities were ancillary to its primary operations and supported its work under the contract with the Emirate. Beta LLC is taxed at the Emirate level, and its other activities were both ancillary to the contract and contributed not more than 5% of total revenue. Under Article 8 of the Corporate Tax Law, Beta LLC is entirely exempt from federal corporate tax. Public benefit entities. Charities and other types of public benefit entity contribute to public welfare, encourage corporate social responsibility, promote philanthropy and community service. The list of qualifying public benefit entity, QPBE, is listed in the Schedule of Cabinet Decision No. 37 of 2023. As per Article 9.1 of the Corporate Tax Law, the QPBE must meet the following conditions to be eligible for corporate tax exemption. Must be established and operate for any of the following: exclusively for religious, charitable, scientific, artistic, cultural, athletic, educational, healthcare, environmental, humanitarian, animal protection, or other similar purposes, or As a professional entity, Chamber of Commerce or a similar entity operated exclusively for promoting social or public welfare, must use its income or assets exclusively for the purpose for which it is established or to pay associated reasonable and necessary expenditures, must not undertake commercial activities unless these are directly related to their stated purpose, not use its income or assets for the personal gain of any shareholder, founder, member, owner, settler or trustee of the organization, unless that person is not a QPBE, government entity, or government-controlled entity, must meet any other requirements prescribed in the Cabinet Decision Number 37 of 2023. As per Article 9.2 of the Corporate Tax Law, the exemption will be effective from the beginning of the tax period in which the organization is listed in the Cabinet Decision issued by the Minister signifying that it is a QPBE, or any other date determined by the Minister. As per Article 9.3 of the Corporate Tax Law, the FTA may request any relevant information or records from QPBEs to check that they continue to meet the criteria for approval. As per Article 2.2 of Cabinet Decision Number 37 of 2023, government entities will, on a case-by-case basis, notify the Ministry of any changes occurring to the QPBE specified in Cabinet Decision Number 37 of 2023 that impact the entity's ability to comply with the conditions set out in the Corporate Tax Law. The notification shall be in the form and manner prescribed by the Ministry and made within 20 business days from the occurrence of any change. As per Article 3.1 of Cabinet Decision Number 37 of 2023, any government entity may file an application to the Ministry to suggest an amendment, as addition or deletion, to the schedule of QPBEs in the Cabinet Decision. As per Article 4.1 of Cabinet Decision Number 37 of 2023, a QPBE must provide all relevant documents, data, and information to the Ministry and the authority to verify that it meets the requirements stipulated in the Corporate Tax Law. As per Article 4.2 of Cabinet Decision Number 37 of 2023, all government entities in the state shall fully cooperate with the Ministry and the authority to provide them with all data information and documentation related to QPBE and its activities. As per Article 4.3 of Cabinet Decision Number 37 of 2023, the Ministry and the authority may exchange with each other data information and documents in respect of any QPBE and its activities. Investment funds. Asset and wealth management is centered in the UAE, and the financial services sector is an integral part of the UAE's economy. To attract international investment, there are a variety of investment fund regimes and fund vehicles available. Investment funds are commonly organized as limited partnerships and not as companies. This treats unincorporated partnerships as transparent, which means that investors are taxed in the same way on their fund investment as they would be if they had instead invested directly in the assets owned by the fund. Those limited partnerships that are incorporated are not treated as transparent. They are treated as juridical persons and are subject to corporate tax. As per Article 10 of the Corporate Tax Law, regulated investment funds and real estate investment trusts may apply to the authority for exemption from the corporate tax, subject to meeting following criteria. The investment fund or the investment fund's manager is subject to the regulatory oversight of a competent authority in the UAE, or an equivalent, recognized foreign competent authority. Interests in the investment fund are traded on a recognized stock exchange, or otherwise are widely available to investors. Main purpose of the investment fund is not the avoidance of corporate tax, and any other conditions prescribed by the Minister. The exemption under Article 10 does not extend to persons providing management services to a qualifying investment fund. Such persons will be subject to corporate tax, unless they are outside the scope of corporate tax or exempt under other provisions of the Corporate Tax Law or any implementing decision issued thereunder. Investment funds further conditions. In addition to Article 10 of the Corporate Tax Law, investment funds, excluding REITs, can apply to the authority for exemption from corporate tax as a qualifying investment fund if they meet all the following conditions as per the Article 2 of Cabinet Decision Number 81 of 2023. The main business or business activities conducted by the investment fund are investment business activities, and any other business or business activities conducted by the investment fund are ancillary or incidental. A single investor and its related parties do not have more than 30% of the ownership interests in the investment fund, where the investment fund has less than 10 investors. More than 50% of the ownership interests in the investment fund, where the investment fund has at least 10 investors. The investment fund is managed or advised by an investment manager that has a minimum of 3 investment professionals. The investors shall not have control over the day-to-day management of the investment fund. Article 2.2c of Cabinet Decision Number 81 of 2023 defines ancillary or incidental activities, which in total do not generate more than 5% of the total revenue of the investment fund in a financial year. As per Article 2.3 and 2.4 of Cabinet Decision Number 81 of 2023, the requirement for ownership interests to be appropriately diverse is relaxed in the first 2 financial years in which the fund exists. The 30% and 50% ownership conditions are deemed to be met if there is sufficient evidence to demonstrate the intention of the investors to meet these conditions after the first 2 financial years as determined by the authority. Upon the non-meeting of ownership conditions, the investment fund will cease to be treated as an exempt person from the beginning of the 3rd financial year. Real estate investment trusts further conditions. In addition to Article 10 of the Corporate Tax Law, real estate investment trusts can apply for exemption to the authority as a qualifying investment fund if all the following conditions are met as per the Article 3 of Cabinet Decision Number 81 of 2023. The value of real estate assets, excluding land, under the management or ownership of the REIT exceeds AED 100 millions. At least 20% of the share capital of the REIT is floated on a recognized stock exchange, or it is directly wholly owned by 2 or more institutional investors, provided that at least 2 of those institutional investors are not related parties. On average, the REIT holding of property income-generating assets is at least 70% of the total value of assets held by the fund during the relevant Gregorian calendar year, or the relevant 12-month period for which the financial statements are prepared. Article 5 of Cabinet Decision Number 81 of 2023 defines institutional investors as the federal government, a local government entity, a government entity, a government-controlled entity, a foreign government, its institutions and authorities or the companies fully owned by any of them, international organizations, a bank, an insurance provider, a pension or social security fund, an investment entity licensed by a relevant competent authority or a similar regulatory authority in or outside of the state, any other juridical person determined by the authority. Pensions and social security funds. As per Article 4.1(g) of the Corporate Tax Law, public and regulated private social security and retirement pension funds are exempt from corporate tax. To qualify for an exemption, a fund must be subject to regulatory oversight of the competent authority in the state and meet any other conditions as prescribed by the minister. Private pension funds. To be exempt from corporate tax, a private pension fund must meet following conditions as per Article 2 of Ministerial Decision Number 115 of 2023. Comprise a pool of assets which have been assigned by law or contract as pension plan assets, or the acquisition of these assets has been financed by or with the use of contributions to a pension plan for the exclusive purpose of financing the pension plan benefits. Grant pension plan members or beneficiaries a right or other contractual claim or entitlement against its assets or earnings. Only earn specified income listed in the Article 4 of Ministerial Decision Number 115 of 2023. Have an auditor. Private social security funds. To be exempt from corporate tax, a private social security fund must meet following conditions as per Article 3 of Ministerial Decision Number 115 of 2023. Comprise a pool of assets which have been assigned by law or contract as fund assets, or the acquisition of these assets has been financed by or with the use of contributions to the fund for the exclusive purpose of financing the end-of-service benefit. Only earn specified income listed in the Article 4 of Ministerial Decision Number 115 of 2023. Have an auditor. Categories of income that must be earned by the fund. Article 4 of Ministerial Decision Number 115 of 2023 lists below sources of income for a private pension fund or private social security fund to be exempt from corporate tax. Investments or deposits, where the investments or deposits are held for the purposes of fulfilling the obligations of the fund, and the investments do not constitute a business operated by the fund. Underwriting commissions that are charged for the purposes of the fund. Rebates of charges due or paid by the fund to persons involved in managing part or all the assets of the fund that are not deemed as compensation for services provided by the fund. Any other income derived in accordance with a defined investment policy for the benefit of pension plan members or beneficiaries of the end of service benefit, as applicable. Administration. As per Articles 6.1 and 6.2 of Ministerial Decision Number 115 of 2023, where a fund has been granted exemption, its auditor must give an annual statement confirming the fund's compliance with the above conditions. The auditor is also required to report any breach of the above conditions to the authority. Ceasing to be exempt. The authority may withdraw a fund's exemption from corporate tax if any of the following apply. The auditor confirms that the fund no longer meets the above conditions. The authority finds that the fund no longer meets the above conditions. The auditor fails to give an annual statement confirming the fund's compliance, or the auditor fails to report a breach of the conditions by the fund. Family foundations. As per Articles 16.1 and 17.1 of the Corporate Tax Law, a family foundation is a taxable person, unless an application is made for it to be treated as an unincorporated partnership, which is not considered a taxable person. This ends our video session. Subscribe to our channel, and click on notification icon to stay tuned to the series of valuable material that will cover all aspects of the UAE corporate tax. Our partner is available for free consultation who is holder of FTA-approved UAE corporate tax qualification. His contact details are provided here. Visit finexcel.ae. Navigate to our clients and testimonials webpage to see more clients' review on our services and our major clientele. Contact us for more detail. FinExcel. We create value that matters.